When you look at the fundamental laws of business physics, right, there's usually this very strict, undeniable relationship between mass and agility.
Oh, absolutely.
Yeah, like as a company scales up and acquires massive market share, it naturally slows down. The bureaucracy thickens, you
Like
know.
the revenue base becomes so large that moving the needle requires just monumental effort.
Exactly. And growth stabilizes into this predictable, kind of boring crawl. You expect a trillion-dollar company to behave like a utility, not a startup.
Yeah, that's the standard model.
But looking at the latest data for Alphabet, ticker symbol GOG, the math we are seeing completely breaks those traditional laws of business physics. I mean, we are looking at a $4.23 trillion mega cap behemoth that is pivoting and accelerating and capturing new market share with the aggression of like an early stage disruptor.
It really forces us to entirely rethink how giant tech monopolies operate in the modern era. Because, the assumption was always that once you dominate a sector, your primary job is just defending the castle.
Right, building a moat.
Exactly. But Alphabet is actively building 3 new castles while simultaneously renovating the original one.
It's wild. Welcome to this special time in market deep dive. For you listening right now, our mission today is to tear into the reality behind Alphabet's Q1 2026 earnings report, which just pushed the stock to record highs.
Yeah, we are going to look under the hood of their staggering infrastructure spend,
Yeah.
figure out how AI is actually changing their core ad business, and ultimately determine if the current valuation makes any logical sense.
And before we get into the heavy machinery of these numbers, I need to give our standard required disclaimer. This discussion is for entertainment purposes only, and you should always seek professional advice for any investment decisions.
Yeah, we are looking strictly at the data, the underlying mechanisms driving these numbers, and what the financial community is modeling. Portfolio decisions are entirely up to you.
Okay, let's unpack this because Wall Street was bracing for a solid quarter, but the actual numbers fundamentally altered the consensus models. I mean, total revenue hit $109.9 billion for the quarter.
Which is just a staggering figure.
It really is. That is a 21.8% year-over-year increase, marking their 11th consecutive quarter of double-digit growth. But, top-line revenue is just money coming in the door. The metric that truly caught my attention was the bottom line.
For earnings per share.
Yeah, GAAP earnings per share came in at $5.11. To put that in perspective, the analyst consensus was sitting around $2.62.
Wait, really? That's almost double.
Yeah. Beating profit expectations by over 90% at this scale is incredibly rare. I mean, GAAP EPS is essentially the purest measure of profit attributed to each single share of stock, right? It accounts for all standard expenses and stock-based compensation.
Right, and beating it by that magnitude usually implies a company either had a massive one-time accounting windfall or they gutted their research and development budgets to, artificially inflate profits.
But looking at the source material, they didn't gut their R&D at all. They actually expanded their operating margins to 36.1%.
Oh, wow.
So if they didn't slash costs to the bone, how does a company mathematically generate that much unexpected profit in a single 90-day window?
Well, it comes down to operating leverage. When a software or infrastructure company reaches a certain scale, the cost to deliver their service to the next marginal customer drops close to zero.
Right.
So Alphabet grew their revenue by nearly 22%, but their fixed costs, the data centers, the algorithms, the core staff, didn't grow by 22%.
Ah, I see.
Once those fixed costs are covered, almost every additional dollar of revenue flows straight down to the bottom line as pure profit. They've built an infrastructure so efficient that as demand spikes, profitability actually accelerates.
And the primary driver of that demand spike is very clearly Google Cloud. I mean, cloud revenue surged 63% year over year, hitting $20.03 billion.
That's a massive jump.
Yeah, and during the earnings call, CEO Sundar Pichai noted that the cloud backlog nearly doubled quarter over quarter to over $460 billion. Now, a backlog is technically just a promise of future revenue, right? Why is Wall Street treating a $460 billion IOU as if it's already cleared the bank?
What's fascinating here is that in the enterprise software world, a backlog isn't just a loose verbal commitment. It represents legally binding contracted spend.
Oh, so it's locked in.
Exactly.
Sure.
What makes that $460 billion figure so critical is the context of the timeline. If you rewind to 2024 or 2025, the corporate world was in this AI experimentation phase. Companies were running small, localized pilots trying to figure out if generative AI was a real utility or just an expensive parlor trick.
Right, they were playing around in the sandbox, essentially.
Precisely. They were spending a few million here and there on localized deployments. A backlog doubling to almost $500 billion proves the sandbox phase is officially over. Yeah. Fortune 500 companies have concluded that AI drives tangible efficiency, and they are now signing massive multi-year contracts to rebuild their entire corporate infrastructures on Google Cloud. It shifts AI from theoretical research and development budgets into mandatory operational expenditures.
And that transition from theory to operation requires a physical backbone, which brings us to the most staggering data point in our sources. I mean, renting out the digital factory to enterprise customers is a brilliant, high-margin business, but actually building that factory costs an absolute fortune.
It's not cheap, that's for sure.
Right. To maintain this explosive cloud growth, Alphabet is boosting its 2026 capital expenditure to somewhere between $175 billion and $185 billion.
That is just a huge number.
It's nearly double the $91.4 billion they spent in 2025. Here's where it gets really interesting, though. Spending $185 billion in a single 12-month window feels less like strategic growth and more like a panic, high-stakes arms race against Microsoft and OpenAI.
Well, the arms race dynamic is certainly a factor, yeah. But we have to look at what that $185 billion is actually buying. They aren't just buying servers. They are laying down the physical tracks for a new era of global computing.
Okay.
A significant portion of this is going into their proprietary TPUs, or tensor processing units.
Let's break that down for a second because we hear a lot about standard GPUs, graphics processing units powering the AI revolution. Why is Alphabet pouring billions into their own custom silicon instead of just buying off-the-shelf components from major chip makers?
Well, standard GPUs are fantastic, highly versatile pieces of hardware. They can render video game graphics, mine cryptocurrency, or run complex AI models.
Right, they do a bit of everything.
Exactly. But because they are versatile, they aren't perfectly optimized for any one single task. Google realized years ago that relying on the open market for versatile chips would create supply chain bottlenecks and cap their efficiency. So they designed TPUs from scratch. Yeah, these chips are fundamentally hardwired to do nothing but the specific, complex matrix math required for deep learning and neural networks.
So they bypass the external supply chain entirely and dictate their own hardware destiny.
And it pays off in processing volume. The source documents note that their first-party models, like Gemini, are now processing 16 billion tokens per minute.
Wait, per minute?
Per minute. A token is essentially a piece of a word, maybe 3 or 4 letters. Processing 16 billion of them every 60 seconds means their internal infrastructure is digesting, analyzing, and generating the equivalent of millions of entire books every single minute of the day.
That is mind-blowing.
You cannot sustain that kind of compute volume on rented or generalized hardware.
Yeah.
You have to own the silicon.
But hardware is only half the equation for enterprise customers. Alphabet is also aggressively expanding through inorganic growth, specifically the $32 billion all-cash acquisition of the cloud security firm Wiz, which closed in March.
Right, a massive deal.
Yeah, they took $32 billion in cash and just bought one of the premier security architectures on the market. Our sources indicate this makes the Google Cloud offering sticky. Now, I understand the concept of customer retention, but mechanically, how does a cybersecurity integration lock a massive corporation into a specific cloud provider?
It really comes down to the concept of switching costs. Wiz isn't just a software program you install on a single computer. It is an overarching security environment that maps out a company's entire cloud infrastructure, hunting for vulnerabilities across databases, applications, and network layers.
Okay, so it's deeply embedded.
Exactly. Once an enterprise integrates Wiz to monitor their sensitive data, it becomes deeply entangled with how their data is stored and routed on Google Cloud.
So if a company wanted to switch to Amazon's AWS or Microsoft Azure to save a few bucks on hosting, they can't just copy and paste their files.
Not at all. They would have to rip out their entire threat detection system, essentially flying blind, while they rebuild their security architecture from scratch on a new platform.
Oh man, that sounds like a nightmare for an IT department.
For a global bank or a massive healthcare provider, introducing a multi-year security vulnerability just to save a fraction of a percent on cloud hosting is a non-starter. By integrating best-in-class security directly into the foundation, Alphabet turns their customers into permanent residents.
So the cloud division is practically minting money, the infrastructure is scaling beautifully, and the customers are locked in. But we have to look at how this massive AI transformation is cannibalizing the traditional engine of the company. Because at its core, Google is still an advertising business.
Absolutely. The bread and butter.
Yeah. Search and other revenues came in at $60.39 billion for the quarter, which is up 19%. However, I'm looking at the broader competitive landscape, specifically the threat from Meta. Meta has essentially monopolized social media advertising and is rapidly pushing into search with its Meta AI and the Llama models.
Right.
Over the last 2 years, Google's search growth is 13.8%, while Meta's was 22.7%. And YouTube ads were one slight miss at $9.88 billion, though still up 11%.
Meta is undoubtedly growing faster in percentage terms, operating from a slightly smaller absolute revenue base, and they are executing their AI integration very aggressively.
This brings up the classic innovator's dilemma. For 2 decades, Google's business model was simple. You search for something, they show you 10 blue links, and they place a few highly relevant advertisements at the very top. If you click an ad, Google gets paid.
Simple and effective.
But now, with AI overviews, the algorithm simply reads the internet for you and prints the exact answer right at the top of the page. It feels like Google is building a hyper-fast, incredibly efficient highway that completely bypasses their own legacy billboards.
That's a great way to put it.
Right, like if the AI just tells me the answer, I never need to click a link, I never need to click an ad. How does the core business survive if they solve the user's problem instantly?
If we connect this to the bigger picture, that highway and billboard analogy is the perfect way to visualize the fear the market had regarding AI search. But the early data shows they aren't bypassing the billboards. They're actually replacing them with highly specific premium toll booths on the off-ramps. The fundamental nature of how a user expresses intent is changing.
How so? I mean, people are still just looking for things to buy or information to read, right?
True, but the complexity of the request has evolved. In the era of the blue links, you searched using fragmented keywords because that's all the engine understood. You typed best running shoes.
Yeah.
Google showed you ads for Nike or Brooks. It was a broad guess at what you wanted.
Yeah.
Today, users are inputting long, conversational, highly complex queries into the AI overview.
Oh, I do that all the time now.
Exactly. Instead of best running shoes, a user types, I am training for a marathon in a rainy climate. I have flat feet, and I need a shoe that lasts at least 500 miles.
The AI is catching the nuance of the user's actual life, not just matching a keyword.
And that nuance is a goldmine for monetization. Because the AI understands that incredibly specific intent, Google doesn't just show a generic shoe ad. They can place a hyper-targeted advertisement for a waterproof marathon shoe designed specifically for flat arches, right alongside the AI-generated answer.
Wow.
Advertisers are willing to pay a massive premium to be placed against that complex query because the user is at the absolute bottom of the purchasing funnel. They are ready to buy. So while the overall volume of ad clicks across the internet might decrease, the value of the specific clicks Google captures on these complex queries skyrockets.
The quality of the intent is subsidizing the drop in raw traffic. That is a fascinating pivot.
It really is.
Taking all of this operational reality, the hyper-targeted ad retention, the locked-in enterprise cloud growth, the custom silicon, we have to apply this to the actual stock. Ticker symbol, GOOG.
Let's do it.
Let's answer the core question for the listener. Based on the traditional valuation metrics provided in the data, what is the verdict on the current share price?
This is where we see a profound tension between historical valuation models and future growth expectations.
Yeah, the stock is currently trading near record highs, bouncing around the $347 to $365 range following this blowout Q1 print. Now, the sources note some interesting historical context. Warren Buffett bought 17.8 million shares back in Q3 of 2025 at an average price of $209.06.
A brilliant play by Buffett.
Absolutely. So his thesis was obviously spot on, securing immense value. But for someone looking at the stock today, the key multiples paint a much more expensive picture. Alphabet's forward price-to-earnings ratio is currently sitting at 29.59.
Which is a significant premium compared to its own 5-year historical average of 22.45. A forward PE approaching 30 for a company already valued at over $4 trillion suggests the market is pricing in near flawless execution for the foreseeable future.
And the relative valuation models in our sources confirm that. Like, if you run a 10-year discounted cash flow analysis using a 9% growth expectation, a 10% discount rate, and a 2.5% terminal rate, just standard base metrics, the intrinsic value is estimated to be somewhere between $240.89 and $312.55.
Right.
Because it's trading in the mid-300s, the models officially categorize the stock as sitting in the overvalued zone, carrying a premium of about 11.18%.
Yeah, it's trading at a premium.
So on paper, that intrinsic value calculation gives us a fundamental hold or sell verdict. The math screams that it's priced for perfection. But here is the massive contradiction. Despite the traditional models flagging this as 11% overvalued, Wall Street's sentiment is aggressively bullish.
It's universally loved right now.
Right. Out of the analysts reviewed in the source material, there are 26 explicit buy ratings and exactly 0 sells. Firms like TD Cowen are even raising their price targets to $375. So what does this all mean? If the historical math says the stock is too expensive, why are 26 out of 26 Wall Street analysts treating it like a mandatory portfolio addition? Are the traditional PE models just broken when dealing with a company that owns the underlying architecture of artificial intelligence?
Well, the models aren't broken, but they inherently struggle to price in the durability of a systemic technological shift. Wall Street analysts are looking beyond the raw earnings multiple and focusing heavily on capital return signals, specifically the dividend.
Oh, right.
Alphabet recently announced a 5% dividend increase, bringing it to 22 cents per share.
I have to pause right there because the mechanics of that are wild. We just established they're spending upwards of $185 billion in a single year on data centers and TPUs. They just spent $32 billion in pure cash to acquire Wiz. And after all that historical, unprecedented capital outflow, they still have enough free cash flow to increase a cash dividend to shareholders.
That is precisely the signal analysts are reacting to. A board of directors does not authorize a growing permanent cash dividend if there is even a shadow of a doubt regarding future liquidity.
Right. You don't give money away if you think you'll need it.
Exactly. Paying a dividend while simultaneously funding the most expensive infrastructure build-out in corporate history signals supreme, unshakable confidence. It proves to the market that the cloud margins in the AI monetization are not temporary hype-driven spikes, but permanent, durable cash engines.
Makes sense.
Analysts are willing to pay an 11% premium on the share price because that premium buys you unparalleled financial safety in a highly volatile sector.
It is the ultimate flex of corporate strength. You are paying a premium, yes, but you are buying into a monopoly-like scale that is managing an incredibly delicate transition flawlessly.
It really requires deciding how much you value certainty. Traditional value investors might balk at a 30 PE ratio, waiting for a broader market pullback to find an entry point.
Yeah.
But momentum and growth investors argue that trying to pinch pennies on the premier asset in the artificial intelligence space means you risk missing the compound growth of the next decade entirely.
As we bring this analysis to a close, I want to leave you, the listener, with one final, incredibly provocative detail from our sources to mull over. We've spent this entire time talking about Google as a foundational layer for global business and enterprise security.
Right.
But recent developments show they are also becoming a foundational layer for national security. Google just reached an expanded, amended agreement with the U.S. Pentagon, allowing for the direct API integration of its commercial AI systems into military environments.
This is a monumental shift in how the government utilizes commercial technology.
Let's explain that mechanism briefly. What does an API integration physically allow a military environment to do with Google's AI?
An API, or Application Programming Interface, essentially allows two different software systems to talk to each other in real time.
Okay.
By allowing direct API integration, the Pentagon isn't just buying off-the-shelf software. They're securely piping the raw, immense compute power of Google's AI models directly into their own classified, secure defense networks.
Oh.
Yeah, it allows military analysts or automated systems to query Google's architecture instantly, applying that AI to logistics, threat detection, or strategic modeling without ever moving the classified data onto public servers.
Now, I want to be perfectly clear here. We take absolutely no political sides on this show. We are merely reporting the facts of the tension presented in the sources. The U.S. government clearly believes it needs cutting-edge AI to maintain national security. However, this Pentagon agreement has sparked severe internal pushback.
Yeah, that's not surprising.
Hundreds of Google AI researchers sent an open letter to the CEO urging the company not to make its commercial systems available for classified defense workloads.
It is a direct echo of the severe backlash we saw back in 2018 when employee protests successfully pressured Google into withdrawing from renewing a major Pentagon computing contract.
Exactly. The workforce has profound ethical lines they do not want crossed regarding how their algorithms are utilized. But the executive team is balancing those internal ethical demands against the reality that they are now building the most powerful technological infrastructure on the planet, and the government is essentially demanding access to it. The tension is very real, and it is playing out in real time.
This raises an important question for anyone evaluating the company. As Google's cloud architecture, proprietary silicon, and AI models become the indispensable backbone for everything from everyday web searches to global banking logistics and now direct military defense infrastructure.
Yeah.
Does buying GOG simply mean you are investing in an advertising and technology company, or are you effectively investing in the digital infrastructure of a nation-state?
It fundamentally changes the risk profile and the gravity of the investment. We started this deep dive talking about the physics of giant corporations, how mass usually destroys agility.
Right.
But when a company possesses a $4.2 trillion valuation, 63% cloud growth, and holds the literal keys to both corporate and national security computing, well, traditional business physics no longer apply.
Not at all.
They aren't just navigating the market anymore. They are dictating the current that the rest of the economy has to swim in. Thank you for joining us on this deep dive. Keep questioning the data, keep looking beneath the surface, and we'll see you next time.